The following program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group. Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, sorry for the lateness. If you'd like to call us, 216-901-0945. 216-901-0945. I hope everybody's having a good Easter weekend. Or whatever your religion is, it doesn't really matter. Just hope that you're having a good day. And speaking of good days, I think we're going to have a good day on May 10th. That's actually a Thursday. That's when we're doing a seminar, learning basic portfolio management skills. We're going to be talking about this on an ongoing basis. And you can go to my website to learn more about it, bullingtoncapital.com. I did just send out a very small, it's less than 1,000 words, an article on a relatively simple method to evaluate a stock, at least to begin your evaluation, to try to determine whether or not it may be overpriced. And I got questions from some people who basically say, well, why would anybody want to learn this? Because isn't that what your job is? And I'm like, yeah, well, here's why you want to learn it, so that you can learn to pick a good advisor. If you don't know how to manage investments, how do you recognize someone else that does? And I can tell you that the vast majority of people will go and just look at the top performing fund over the past 1, 3, and 5 years, not realizing what they're doing. So you got to look at you have to know a little bit more than that. And short-term performance is not the way to manage your money. It's a really good way in the long run to end up in a world of hurt. The S&P 500, which everybody likes to compare themselves to, was down 50%. Twice in one 10-year time period. Now think about that. It was down 50% twice in one 10-year time period. So if you're down 50% and you're taking money out to try to supplement your income in retirement, you might be back to work right now. And because you didn't know any better, you invested in a market cap weighted index because you looked at the returns. And that's not all there is to investing. If it were that easy, and just looking up the history, every librarian and every history teacher in the country would be billionaires. They would all be rich. It takes a little bit more than that. You need to try to figure out how much risk they're taking. That's a big key. How much risk are they taking? You need to get to be able to look behind the scenes in a mutual fund or an ETF that you're interested in. Not that you're going to do that. And I get a lot of resistance from this from some people. Say, well, I don't want to know any of that. Well, okay, then you're just at the mercy of whoever you're talking to, and that's a tough place to be. If you know just the basics, and they're really not even that hard. The basics are not that hard. Requires a little bit of concentration, not a lot, especially the way that I present it, because I just go to the most important things. In fact, the 95% of your success are based on relatively simple principles. The other 5%, it can make a difference. It can. But the 95% of it is it's not that difficult. And there are 1 out of 20 situations where it's going to be a lot more difficult than average person, and even the above average investment advisor is going to be capable of spending the amount of time it takes to decipher and to get some useful knowledge out of it so that it can help you. And since that's only about 1 out of 20 generally, then you don't have to worry too much about that. And to summarize this whole thing, which is kind of messy, if you get the basics down really well, you're going to be able to identify other people when you're talking to them to find a good investment advisor for yourself. And if that's what you're looking to do. And that's why I think it's so important. And quite frankly, it's fun. For some people. A lot of people, they really enjoy it. And I enjoy it. So I put out this little newsletter. It's a little article, and then, feel free to call or go to my website and request it. I'll send you a copy. And it was just to kind of give you an idea of how to look at companies, how to compare companies, how to compare a company to not to compare a company, but actually how to evaluate a company and try to determine whether or not it's overpriced or underpriced. Now, by the way, this is step 1. And this is probably, it's 50% of what you need to know. Now, the other 45%, remember, we're not going to 100. At some point in time we might, but for right now, we're going to 95% of what's important. The other 5% is really tough. I'll keep reminding you of that as time goes on. So this is the first 50%. We're going to take a look at what a company is selling for today, and is it overpriced or underpriced? And again, why would you need to know that? Well, because if you don't know this, you won't be able to look into the recommendations that you're being given, whether it's through the internet, a newsletter, or another financial advisor. You won't be able to look into it intelligently to figure out whether or not it's something that really suits your personality when it comes to investing. What do I mean by that? It suits my person. What are you talking about? Well, see, there are different styles of investing, and if you're not familiar with them, you're going to be subject to their mercy. When growth has done very well, like over the past 4 to 5 years, large companies that would be considered growth companies have done incredibly well. Small cap undervalued stocks are even more undervalued now. So the returns have been leaning towards the growth category. And if you went to the 5 years prior to that, it was a category they call value. That was actually the long-term winner, and still is if you go back far enough. But it's very misleading going over the past 5 years thinking, oh, I'll just project that out into the future and that's it. Well, no, that's not it. I'm here to tell you that those categories, the growth categories that have done the best, have the stocks that have the most overvalued prices in them. And you don't really want to be hanging around there too long. So those categories that have been underperforming are actually more attractive to a business owner, which should be you. As an investor, you are a business owner. Those funds that you're investing in are buying shares in companies. That makes you a part owner in those companies. So as an intelligent business owner, you want to try to get a good deal, right? You want to try to get a good deal, something that is at least adequate. And you don't want to be buying stuff that in the long run is going to cost you money. And that's where it gets really confusing, because in the short run, when you see stocks like Facebook and Twitter, it can be very attractive when their share prices are going up. But when they're going up for not a good reason, they come down really fast. Anyway, I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
The mistake that left you a million miles away from the you once knew. Now yesterday's shame keeps saying that you'll never get back.
And we're back. But I can't hear myself. There we go. And turn my own volume down. You're listening to Bill Bullington right here on 1420 The Answer, here every Saturday morning from 11 to noon. Also, this show, if you miss it, is available as a podcast on 955thefish.com. and also on my website, bullingtoncapital.com. And if you'd like to call us, the number is 216-901-0945. And I'm going to go right to the phones now with Phil. Phil, do you have a question, comment?
Hey, Bill, I got a question for you.
Okay.
First of all, by the way, your show does still show on 6 o'clock on Sundays, too.
Yeah.
Is that the podcast you're talking about?
No, that's actually, they rerun the show at 6 on Sunday. Actually, I think they moved that now to 12 o'clock on Sundays on the other station. But, yeah, it comes up there, too. Thanks.
Hey, yeah, I got a question for you. You're not a real, you're a real smart guy. I'll give you that. But you're not like a tax professional. Am I right by saying that?
Oh, yeah, we're not allowed to. Actually, we you can't give tax advice anymore in my industry unless you are licensed for it. So,
like if we were just two guys talking, and if you can't talk, that's okay.
Yeah.
You can tell me. I was thinking about taking some of my regular IRA, and I'm in the 12% bracket.
Mm-hmm.
Would it be a good idea to take some of that and put it into a Roth?
It could be, and there are so many variables that you have to consider there. But when your tax rate's really, really low, that probably makes a lot more sense, to do it that way.
Okay.
And you have to remember though that will increase your income that year.
Right, exactly.
So.
Well, I would just take enough out of it to take me to that next level, and I'd stop. You know what I mean?
Yeah. Yep. Yeah, that's the and by the way, I can actually put you in touch with people that will run the numbers for you. Literally, tax advice is not covered under our E&O insurance.
Yeah. Okay.
So
I understand.
Yeah, but it could be a really good idea, especially if you're in a really low bracket, and that might be a good thing to consider.
Now, is that a temporary thing? This current tax system we're enjoying, is that a 5-year thing, or did I just read that up?
And here's the thing that I think is kind of funny. If you look at it, the tax system's never been permanent. It's always been changing.
Right.
And so I would go with the last couple hundred years and say it's probably going to change again.
Thanks.
So at some point in time, it's going to have to, because you can't. It's really nice that the breaks that the average person got in this tax bill they appear to me not to be as significant as the breaks are to the extremely wealthy,
gotcha.
who obviously needed the break, right?
Somebody like yourself,
I got to tell you, I'm looking there. No, the uber wealthy, like the top 1% or 0.5%, they got the biggest breaks.
Okay.
And so that, you're talking, they're pretty big.
Gotcha.
That adds to the deficit, which adds to the national debt. And at some point in time, this is kind of the cycle that I kind of see developing. At some point in time, we're going to have inflation that's significantly higher than we've experienced in the past 20 years.
Mm-hmm.
And could get back to the levels that you saw in the late 60s and early 70s easily.
Hey.
So if we get to that point, then it's going to be pretty tough, because most people think that the stock market's going to go down, it's going to crash, and it's never going to come back up again. That is not what's going to happen. It'll do like it did in the 1970s, inflate. Well, I shouldn't say that is not. The likelihood of that, at least in my opinion, is very low. I think the likelihood of the 60s and 70s is much more likely, when the stock market didn't make a lot of money, especially the S&P 500. It was flat for 13 years. And inflation was running in the mid-teens. And so money was worth a whole lot less. But people didn't really complain that much about it, because they got a 9% treasury that actually ended up topping out the 30 years at over 15%, or close to it anyway. And then the short term went even higher. You could get a money market account, which were brand new in the late 70s, by the way. Nobody even knew what they were before then, because they didn't exist. But a money market account, which was full of short-term government treasuries, was paying 18%. Yeah.
I remember that.
Yep.
Yeah, that's
so
good.
that's called an inverted yield curve, by the way. The short-term government bonds were paying more than the long-term ones, which is not supposed to be the case. But that's what happened. So people that had long-term bonds, they lost a lot of money, while the people that were just having money market savings accounts were making enormous amounts of money. So that situation is really tough. The amazing thing about it is that people don't realize if prices double and your assets stay the same, they don't grow or they don't keep up with that, it's the same thing as if the market had crashed by half. It's the same thing. And
no good.
Yeah, no, it's really tough. But if you take a poll, you ask people, would you rather see prices double or your assets get cut in half? They all say, I'd rather see the prices double, not realizing that it's exactly the same thing. If the prices double on everything that you buy and your money hasn't grown and kept up with that, it's the same thing as losing half your money and prices staying the same.
I got you. Yeah.
So that's the real risk. Yeah.
I'm surprised that inflation hasn't heated up, considering what's been happening for the last, say, 10 years or so.
Oh man, you know what it reminds me of is I think it's going the same place those socks go when they go in the dryer and never come back again.
I have that. Yeah.
Yeah. Where is that? Yeah. Where is the inflation? I mean, inflation's there. It's just not as rampant as it was in the 60s and 70s. But when you look at certain inflation rates are really high. The elderly, the medical expenses have gone up 2 to 3 times more than the average, the published inflation rate. And so it's been really tough on our senior citizens because, when you get older, your body starts to wear out. You have to go to the doctor more frequently, and it's been the costs there have been rising way faster than the average inflation rate. So they've experienced an entirely different inflation rate that, say, people in their 30s and 40s would experience. The younger, pardon me?
I'm in that gang,
Yeah.
Yeah.
Me too.
Elderly, I'm called. Elderly.
Same here. I've had a AARP card for over 5 years now.
Attaboy.
Yep.
Hey, I had a theory about that, and it was this: why inflation hasn't really been rampant yet, is that so much money evaporated during that meltdown, and from 2007, 8, and 9. So much, not value, but big money just disappeared.
Yeah, it's interesting. It's kind of like electricity, though. It doesn't really disappear. It just dissipates. It spreads out. So you're right. It's still there. It's still there somewhere. And that's sooner or later, higher inflation is probably going to be a result.
Gotcha.
Yeah.
Okay, good. All right, thank you. I enjoy your show, Bill.
Oh,
good
thanks.
job.
Hey, have a good weekend.
You too. See ya.
Yep. Bye-bye. And I'm going to Brian. Brian, you have a question? Brian. Hello?
Oh, hey, Bill.
Hey, how you doing?
Good. How are you?
Good.
Great. Hey, I had a question. Bill, the newsletter or the little thing you sent out about the semiconductor ETFs?
Yes.
So I was trying to, obviously that's huge diversification because, one ETF, I think one I read had 125 securities in it.
Yeah.
And you got 5. So, obviously it's like the whole industry. So what are your thoughts on, I actually have a little side note. I bought that Smart Global Holdings that you just touched on at the last seminar.
Yep.
I think it's volatile as heck, but I think I'm up 28% on it.
Yeah,
that's been, for 3 weeks?
It's got a good valuation. It's relatively low. It's actually extremely low.
Yeah, 28% in 3 weeks. That's pretty good. So that's great. And then I also happen to own On Semiconductor, ON.
Yep.
And I think I bought that weeks ago just because you've been talking about semiconductors a little bit. So I have those 2 individuals.
Right.
But now I'm thinking to myself, well, shoot, maybe I should be a little less aggressive and get some. So what are your thoughts? Maybe take all 5 of those ETFs and just, because I have folio, obviously, so just do a little basket.
Yeah, well, that's what I'm doing.
5.
And in fact, we got a basket there. If you want, you can talk to Gary and he can put you in that. I
have my individual folio too that I'm running my IRA through.
Right.
So I can just do it myself and just.
And I'll tell you why I did it that way. There's less overlap in the ones that I chose.
Okay.
Yeah, there are a lot of other funds that you could use, but they all approach that industry rather, in a slightly different way. So we're getting a broader exposure with less overlap. Some people just buy the stocks. Well, you got 12% of your money in NVIDIA in that index. It's a market cap weighted, and NVIDIA is it's overpriced. It might just keep on going because that's what a lot of overpriced stocks like to do. In fact, it was up 4.6% yesterday. But you got a company out there that's got revenue close to $10 billion, but it's got a market value of the stock of $140 billion. So it's 14 times. That's
wow.
Yeah, that's kind of crazy when Smart Global Holdings is at 1.
Sure.
Would you rather pay 1 or 14? That's my point. So if you were only holding
and that's the thing. No one's even heard of that. That's what I like about you. It's like, some people they only talk about things everyone's heard of,
Right.
Apple and NVIDIA, It's
right.
like,
yeah,
that's interesting.
So
obviously, just a few percentage points of your portfolio value you threw in that basket of, that would be obviously safe and all that. I mean,
it's safer because you're
proper,
spreading it out,
portions.
right? Because by the way, the technologies, the way that they're evolving, it's really going to be a big shot in the arm to almost all the semiconductor manufacturers. So it's not something that one or two of them are going to dominate, and that's a really good thing. That's an awesome thing. I'd rather see it that way. I'd rather see it be much more spread out across an entire industry than one or two companies getting most of the benefit. And certainly there will be some companies that do better than others, but all other things being equal, this whole industry is going through a renaissance that they haven't the likes of which they haven't seen since the late 90s when everybody was getting a computer and was getting online for the first time. So this is at least as changing as that was. And actually more so because now everybody, back then you didn't have nearly the number of users of all this technology that you have today.
Sure.
So the market's already there. It's already built. You had to convince people to get a computer and get online, and it was really expensive relative to their incomes at that point in time. So the cost of these devices has dropped. Income levels are much higher, and the uses for them are many times more than the uses that we had available during the late 90s. So now, is it going to do what they did? I hope it doesn't get like super overvalued and then crash, because it's really easy to sell something when it's up a lot. Everybody wants to buy it when it's up a lot, not realizing that, it's going to come down. So I'm hoping that's not going to get repeated. And if it does, I'll let you know, and I'll probably start cutting out of there. But right now,
so basically, you just buy all 5 ETFs and have a little folio of semiconductor ETFs.
Yeah,
all today.
Yeah, absolutely.
Okay, awesome.
Yeah,
make it simple. Thanks, Bill.
All right. Well, hey, thanks for calling. Have a good weekend.
Have a good Easter.
Yep,
you too. Bye-bye.
And I think I got a couple minutes here before the commercial break. So I'll just remind you, and I will talk about that at the next seminar too, if you want to bring that up. In fact, that's a major change. It's going through. It affects everything. It affects your cell phones, your computers, your laptops, your notebooks, or your iPads. Everything. It's going to affect cable television. It's going to affect your cars, and it's already affecting them. They're already rolling that technology out. So we'll be talking about that because that's a long-term driver, kind of like cable was back in the 80s, cell phones, the internet back in the early to mid-90s. This is one of the next big drivers because it makes an awful lot of things an awful lot easier to do, and it's cool. So nothing is as constant as change, and this change is happening. It's actually been going on for quite a while, several years, but it's picking up a little bit of steam. It's nowhere near the level it's going to be 4 to 5 years from now, and 10 years from now, I think it goes a lot further. So kind of interesting. It's a good time to be trying to get some of that exposure in there. And if you heard the conversation between Brian and myself, we were talking about two companies, NVIDIA and Smart Global Holdings. They're both semiconductor manufacturers. One sells for a whole lot more money than the other one does, which attracts a lot of newer investors because they see the big price movement. Smart Global Holdings is a stock that I've owned multiple times over the years. Well, actually, it hasn't been around that often, so it's actually stopped me out of it several times. Anyway, I hear the music. That means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
Trying to fill the same old holes inside. There's a better life. There's a better life.
And we're back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. Also, you can catch this show as a podcast on 955thefish.com. Or you can go to my website, bullingtoncapital.com, where you can download it there or listen to it. You can sign up for the upcoming seminar. It's going to be Thursday, May 10th. Yeah, Thursday, May 10th. And we're going to be talking about basic portfolio management skills. Having a hard time talking. Anyway, so a lot of people are thinking, why would anybody want to learn how to manage investments when there's so many professionals already doing it? And a few of the reasons are if you learn the basics, you can actually evaluate other professionals to find out which guys memorized the answers to the test questions to get their licenses and which ones understood them. It's a big difference between understanding the answer and memorizing it. So, it's kind of important. You can understand the process of investment management. It's not what you think it is. And I think it's really interesting. I think it's really fascinating, quite frankly. It'll give you confidence. It'll really help you. The more you know about this, the more you'll begin to relax. And I was talking to some people about people in general, and how they seek safety, and we all do. We all seek safety. We want to have comfort, we want to have guarantees. And when you're looking for specific types of guarantees in financial markets, you can be really disappointed. When you're looking for the answers, like how things really work, it gives you that sense of security that you might be looking for to help you relax and not really have to worry too much about what's going on in your portfolios. And so again, just knowing what's happening, knowing the basics is very beneficial just from your own personal satisfaction and lower stress levels. You don't stress out if you really get the process. And it's not all that hard. It does take some work, some effort. There are a lot of people out there that are well-meaning, giving advice that they've gotten from a source that they believe to be reliable, and oftentimes it's either misinterpreted or it's not completely accurate. So that's a problem. But the more you know, the easier it is to deal with that. And I would say that the more common things that you can do, or the more common things that are mistakes people make that you can avoid by knowing this stuff, is just chasing performance alone. And that's a big help. Just learning how not to do that is going to be a big help. The other benefits are, if you're not panicking, you're following your plan and you're paying attention to it, or you're following along with your advisor, who's probably, when you call them, they're there 2 reasons: to help you develop that plan. Secondly, to monitor that plan. Third, to answer your questions when you call in and remind you of why you're doing the plan. And most people are pretty good with that. They're going, they'll call in and, oh yeah, okay, yep, I remember now. So it's one of the reasons I have a job. So I think that's really, those are the most important things. you're going to be able to relax. You'll be able to pick a financial advisor better by knowing how to do it. And it reminds me of that movie, Karate Kid. Why do you learn karate? Or why do you learn how to fight? So that you don't have to. And that really struck home with me. When it comes to investing, I think it's the same thing. Not that you're actually ever going to go out and do it, but you learn how to do it so that you don't have to, so that you can recognize when somebody else is doing the right things. Doing the right things doesn't mean perfection, by the way. That's a big misnomer. It's not about being perfect. That's an idea that somebody that doesn't have a lot of knowledge or experience has. I'm going to find perfection. It's not even close. In fact, doing the right thing means you're probably going to have money in some asset classes that are not performing well at all at any given moment. And you'll have some of the money in some of the asset classes that are performing really well if you're doing the right things. And the average of those turns out to be typically very satisfactory. That's what it turns out. Over long time periods can be satisfactory. I think that was what Ben Graham used to say. He used to say, your results will be satisfactory. This guy averaged 14.5% a year over his lifetime after having gone through the big crash in 1929 and going through the Depression. So despite the fact that at one point in time it was down 70% and had a really tough time, his lifetime average was 14.5%. How do you like that? That's pretty awesome. By the way, he was Warren Buffett's first employer and his finance professor at the Columbia University, where Warren got his MBA. So I think a lot of stuff to be learned from history and a lot of stuff to be learned from people who have walked before us. Thank goodness a lot of them decided to write it down. He wrote a whole bunch of books. And a lot has changed, incidentally. A lot has changed since those books were written. And markets are constantly evolving. They're a little bit different today than they were 4 or 5 years ago. And they're a lot different than they were 10 years ago, and incredibly different than they were 15 years ago. I mean, the differences it's actually speed. That's the biggest difference. It's gotten faster, and volatility, shorter term volatility levels, not necessarily the longer term volatility levels, but it fluctuates a whole lot faster, a whole lot quicker today than it ever has, quite frankly. And a large part of that is because you've got computers out there, and this is all part of what we talk about at each one of the seminars, because you need to know this stuff. Markets are up or down a lot. It's pretty silly to try to capture little twists and turns in the market now. It was hard back when it was easy. Now I'm going to tell you it's almost impossible to do that. And it should be a big relief to most people to realize that you do not have to be perfect to be profitable, that you don't have to sit in front of your screen all day. In fact, that's probably a pretty big negative to your long-term investment results, and that there are lots of opportunities out there. We mentioned 4G, and I still have my master limited partnerships. I'm still collecting my dividends, which really has increased my share count pretty significantly. So at some point in time, when it moves back up again, that move is going to look huge because of all the shares that we've accumulated all this time. It's been very disappointing in the short run, but I've been, it's not my first rodeo. So I've seen this, multiple times. I've seen asset classes and individual stocks stay down for years sometime. In fact, I was looking at NVIDIA, stock that I wrote about in the letter I sent out to my clients, comparing NVIDIA to Procter & Gamble and using this little methodology that we'll be going over at the seminar again. That's very quick and easy. Give you a really quick idea as to whether or not the stock may be overvalued or not. Now, I say may because there's a little bit more to it than I was able to cover in that particular article, so I'm going to be writing future articles on that. But, let me save you from all the torture of not telling you. I looked at Procter & Gamble. Procter & Gamble had $3.75 of earnings per share. That's profits per share over the trailing 12 months. And at its share price, it was right around 4.75% when I wrote about it. All I did was divide the earnings per share by the price to get a yield. $3.75 equals what percent of the price that it was? And I think it was $78, somewhere around there. Anyway, it came out to 4.75%. Why is that important? Well, if you were to buy Procter & Gamble every share at that price, wouldn't you want to know what you're going to get? If you were going to buy the whole company, wouldn't you want to know what you're going to get? Obviously you would. And it's important because other investors know this information. And if you didn't, now you do. So you can join the club. That's why you buy businesses. You're looking to make a profit. Now, somebody will look at 4.75 and say, that's not very good. And you know what? It's not awesome, but it is good, especially when CDs are not paying nearly that amount. Long-term average on a 10-year treasury is 5%, so you're pretty close there. You're really close. If you really like the company, now you're going to go see what the longer-term averages of their profit margins are and what their sales look like. That's the subject of the next article. But going back to where we were, Procter & Gamble got a current earnings yield of 4.75, almost 5%. So if the earnings go up a little bit or the share price comes down a couple bucks, no big deal. You will have a 5% earnings yield. Why is that important? Well, that's the long-term average of the 10-year treasury, and you should get at least that amount on your, stocks if you owned them. There are lots of different topics that we could talk about that shoot off of this topic. But for right now, I just want you to focus on that. And then we're going to compare that to NVIDIA, which makes semiconductors. They make graphics cards. And I'm actually going to have to continue this conversation next week because I hear the music. Anyway, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group. The battleground is set for the 2018 midterm elections for Sunday, April 22nd at Lander Haven. Join Hugh Hewitt, Dennis Prager, Michael Medved, Bob Frantz, and Peter Kirsanow for commentary and frank discussion on the midterm elections at the Battleground Talkers Tour. General admission and VIP tickets on sale now at WHKRadio.com. Act fast if you want to share dinner with one of the hosts. Seats at the table are going quick. The Battleground Talkers Tour is sponsored in part by Artistic Renovations.
Warning. If you're drowning in debt you can't afford, do not let the credit card companies trick you into thinking that you have to pay it all back, because you don't. What the credit card companies don't want you to know is that there's actually a way to get debt-free without paying off your entire debt or going bankrupt. If you have $5,000 or more in credit card debt, you now have the right to let us settle that debt for a fraction of what you owe. For free information, call Credit Associates now. 1-800-900-8598. We'll even show you how much money you could save. If you can't afford to pay off all your debt, do not let the credit card companies trick you into thinking that you have to. Call Credit Associates now for free information on how to get debt-free faster than you ever thought possible without debt consolidation or bankruptcy. We depend on your success and offer a guarantee, so there's no risk. For free information, call now. 1-800-900-8598. That's 1-800-900-8598. 1-800-900-8598.
There's not a day that goes by that I don't hear from somebody, either through an email or a comment or a text message, about how people love their Relief Factor. If you have back pain, neck pain, leg pain, pain from working out at the gym, just pain that you think you have to live with, think again. There's a perfect alternative to ibuprofen. There's a perfect alternative to prescription drugs. Relief Factor, developed by physicians, made from high-quality fish oil and essential nutrients. You know what it works on? I know what it works at. I know what it goes after is the inflammation that causes the pain to begin with. But don't just take my word for it. I can tell you all day long that it works for me, and it does. I take a packet in the morning, a packet in the evening. My lower back pain is completely eliminated. But you try it. Go to ReliefFactor.com. Sign up for the 3-week quick start. It costs just $19.95. You give it a 3-week shot. Decide if it's for you or not. If it's not, you're only out $20. What do you have to lose except for the pain? ReliefFactor.com. ReliefFactor.com. ReliefFactor.com.
Joe Walsh wants you to keep your eyes on the prize.
Every day, Donald Trump will do 7 good things and 7 stupid things. How about you just wake up every morning and understand that? Keep your eyes focused on the agenda.